we're going to go straight into our next speaker, ladies and gents. Now, our next speaker has been in this particular business for over 29 years. Give me an ooh. Okay, and he's got a plethora of experience before that, including being a CFO of a Canadian listed company. Yeah. Give me an ooh for that one. Yes, but he's here to talk about some of the tax things and some of the things that you can implement in your businesses that will help you on the tax side of things. So ladies and gents, can we have a massive round of applause, please, for Chris Wilkins?
Thanks very much for that introduction. I do look younger than my years after that 29. You think I'll be coming around in a wheelchair at this rate. Wilkins Southworth. So we've been going for 29 years. We're based in Barnes, southwest London. And I was asked to explain a bit about the type of clients we've done. So we've done everything from, I was the chief financial officer of a company quoted on the Vancouver Stock Exchange, and that company had timber mills in Lusaka, mining in China, and we actually had some jobs in Kazakhstan. We've also been, we acted for the largest telecommunications business in St. Petersburg, Russia, and we acted for the largest landowner in Bucharest, Romania. All of which is probably not relevant to you. So what we do is we do a lot of property, finance, we act for Mark and Rob's companies, and we do a lot of sort of the type of businesses you'll come across. So I thought I'd sort of give you an idea of some of the things that we've done just in the last couple of weeks. So we had a client that, and we're having this more and more now, where clients are saying, I could do my job basically anyway, I'm just going to take my laptop, disappear off, and I fancy going to Spain. So I said, okay, what do you actually do? And he said, well, we do property finding, so we can find locations, but we don't have to physically go there. So I want to go to Spain, but we're finding that we're losing a bit of, we're losing clients on price. So when he went to Spain, what we looked at is the VAT liability, and it's business to business. And what you'll find is that there is a reverse charge. And in this case, what it meant is the client could go to Spain, not charge VAT on their property finding, and then be 20% cheaper because it's a reverse charge calculation. So what that basically means is that I'm an individual, got a property, he either manages my property or finds me another one. So the reverse charge is, he doesn't charge me VAT from Spain, but on the reverse charge basis, I have to be VAT registered if his services and services like it come to more than £85,000, being the VAT threshold. The services he provides me would come nowhere near it. So I don't have to be VAT registered, he doesn't have to charge me VAT, I save 20%, and he gets a good customer. So that type of thing. The other thing we've done is a client has moved to Portugal, and they're what's called a non-habitual resident. Now, there's been a lot of things in the TV that they say, well, the trouble with Britain is we have this domicile basis, and domicile is literally where your heart belongs. So you may remember Robert Maxwell. Robert Maxwell was born in Czechoslovakia. He lived in the biggest council house in Great Britain, which was Headington Hall in Oxford, which is now part of Oxford Brookes University. So therefore, he was resident in the UK, but non-UK domiciled. So what that meant, he wasn't taxed on any money earned overseas, not remitted here. Now they say that, well, that's an anomaly for British tax law, but if you go to somewhere like Portugal, you're going to be a habitual non-resident for 10 years, you pay your lump sum, never pay any tax. Italy do similar things. So with that client, he said, well, I've got 11, 12 properties in the UK, I'm going to be liable to capital gains tax, can you help me avoid the capital gains tax? Well, what you could do, some people do, is they invoke something called Elizabeth Moyne Ramsey, which is a case under Section 162 incorporation relief, where you put your properties into a limited company. You may be aware of it. If not, you can ask me some questions and I'll run through it in the question and answer session. In this case, what we're going to do is we're going to shift the whole lot to Portugal, not pay UK tax on the capital gain, and not probably pay any tax in Portugal under the non-habitual rules. So there's that type of thing that comes in. If you want to sort of do the more mundane stuff, which is very interesting to us as well, so Mark would say to me, I've got this limited company and I'm going to buy a Porsche, and I'd say, no, that Porsche in a limited company, the benefit in kind would be over £15,000. Why don't we think of another way? So another way is perhaps we form an LLP. So we've got one client who's got has got 4 guys, they've got 4 cars, each car is over £100,000, the wives have got 4 cars. They came to us, we set up an LLP. The benefit in kind on one of those cars is over £15,000. So you can imagine if you do the figures. If you have it in something like a limited liability partnership, a limited liability partnership means you're not an employee, therefore there is no benefit in kind. So the employee doesn't pay benefit in kind, which in this case, a car of over 100 grand will be £15,000. The company doesn't pay Class 1A national insurance on that benefit in kind. The petrol doesn't get assessed. And then in this instance, the wives become members of the LLP. So then we get 8 cars, no benefit in kind charges. If there's an LLP, we've got one limited company we're just starting acting for. They've got a 455 charge. Section 455 is where you borrow money from your limited company. So HMRC say, well, if you borrow money from your company, the company's got to charge you interest. But in addition to that, we're going to charge you 32.5% of that loan. Well, I'm talking about, I'm not quite sure with Liz Trust what day of the week it is as to what the tax is, but let's say it's going to be from the 6th of April next year, so it's 32.5%. And we're going to charge you. So if it's, say, you've borrowed £1 million from your company, you've got to pay £325,000 to HMRC, and HMRC will keep that money till you repay the loan. And this got publicity where you may remember a few years ago in the Sunday Times, it was all plastered on the front page that Wayne Rooney borrowed money from his limited company. Wayne Rooney at that stage was over 18, playing for Everton, probably on, 100 grand a week, and he had a limited company that had image rights. Went to his accountant and said, I need to have some more gambling money. I need sort of 50 grand a week to gamble, and can I have it out? And the accountant said, well, you're going to be subject to PAYE if you take it out of the company, or dividend tax. But either way, the company's going to have a corporation tax liability, then you'll pay dividend tax, and it's your company, or you're going to have PAYE, employer's NI. How about we just lend it from the company? And HMRC said, well, this doesn't make sense. So then they hit a tax charge. That would also not be chargeable if it was an LLP, because an LLP is a limited liability partnership, so it's a partnership. In the old days, you had something called the 1890 Partnership Act, the 1890 Partnership Act. So to give you an idea, while Wyatt was running around in Dodge City shooting everyone, the British were building 1890 Partnership Acts for legislation. That's how advanced we were. Now it's Limited Liability Partnership Act, but it's taxed exactly the same. So it's just a case of getting the right structure. And if you get your structures right, you can find it saves you quite a bit of money. And the whole point about this is that you've got to think about where you want to exit before you enter. So let me give you an idea. At the moment, we're doing things where, let's just say, sake of argument, you've got son or daughter going to university, and they've got, I don't know, £9,250 tuition fees. You've got to pay for the accommodation, £9,000. So let's say that lot comes to 20 grand. If you're a higher rate, additional rate taxpayer, that means you earn more than £150,000. You've got 45% tax, 2% NI. So let's call it 50%. So if I want to give my son or daughter 20,000 to pay for those costs, I've got to earn £40,000, and I'm roughly going to be paying 50% tax and national insurance to get it out. How about we set up a limited company with me and my son, or perhaps my other children, as shareholders? Then they can get a share of dividends direct from the company, which means it's not taxed on me. So the company makes the profits, and then the dividends go straight to them. So say I want to use up to £50,000, and I say £50,000, let's forget the rounding, but basically, personal allowance, £12,500. So that means £37,500 takes me up to £50,000. £50,000 is the cusp upon which I'm paying, that person is paying 40% tax. Now, the first £2,000 of dividends, tax-free. So that takes me down to £35,500. From the 6th of April next year and from last year, dividend tax rate 7.5%. 7.5% on 35,500, less than 3 grand. If I did it as the dad, wanted to give them 50 grand, I'd have to earn £100,000. I'd pay 45% tax plus 2% NI, broadly 50%. So the differences are massive. Can you set up a structure like that? Well, you can. You just got to be careful of something called Arctic Systems, and that was Jones v. Garnett. And with that case, what happened is that there was an IT consultant, and he was earning, let's just say, 300 grand a year. And he went to his accountant, and he said, well, what does your wife do? She said, well, she does the books, but that she looks after the kids, but doesn't have a job. And he said, well, wait a minute. You're earning that much, 300 grand, and from your limited company. So broadly, anything above £150,000, you're additional rate taxpayer. How about, rather than go like that, we go like that? So we give your wife a share. So we give her a share, husband has one share, wife has one share, then the 300 grand profit is now 150 each. So that means neither of them are additional rate taxpayers because they're not earning more than 150,000. So a lot of IT consultants were doing this type of thing. So HMRC said, well, you can't go and give someone one share. They pay £1 or whatever it is for a limited company share, and then you give them a dividend of 150 grand because that's plainly not the market value. So therefore, the bounteous settlement legislation says we're going to tax that back on the husband, so he doesn't get anywhere. So then what happened is it went to the court, it went to First Tier Tribunal, High Court, Court of Appeal, House of Lords, and what happened is that it was decided that I think there's a relief between spouses. So in this case, spouses relief, there's no capital gains tax between spouses, no inheritance tax between spouses because you get the spousal exemption. So you've got to be married. You don't have to be the same sex, but you've got to be married. So cohabitors, it wouldn't work. So they got that exemption. So what you've got to do is, if you want to do it with your kids, you can't claim that exemption, but you've got to do it, you can do it another way. So all you're sort of trying to do is to make sure you take the benefits of the tax system. Now, what's interesting is I was reading a KPMG case. This was a client had a HMRC checked the company's accounts. The accounts were prepared by KPMG, one of the top 4 firms of accountants. And what you've got to bear in mind is the taxation of a situation is based on the accounts, principally. The accounts can be prepared in a number of different ways. And in this case, what happened, it went to court, and the judge said, KPMG could have prepared these accounts under 3 different bases. The first 2, you wouldn't have a tax bill. The last one, you would. So then you say, well, wait a minute, but I gave it to a firm of accountants. How can they come up with different sets of accounts? So I thought I'd sort of go back a bit before we go forwards. And I'd go back just to tell you what a set of accounts are. So this is a company, an inoffensive company called Anodyne Limited. It's got a turnover of £15 million. It's got balance sheet assets of £300,000, and it's got 9 staff. So chunky business, turnover is more than £1 million a year. It's got contractors, but it's only got 9 PAYE staff. So it's a computer consultancy firm, IT consultants, and basically what they do is they have annual contracts with their clients. The clients pay on a monthly basis. So there's not really any debtors at the end of the year because the client pays it each month. So what you've got to bear in mind is the balance sheet is a picture in time. The profit and loss is you're trading over normally a 12-month period. The balance sheet is basically a photograph. So at the end of the year, let's say 31st December, what's your assets, what's your liabilities? So that's just a photograph of your assets, liabilities, and that's what the balance sheet is. So there's no debtors. They rent their offices. They bought their computers last year, and they're all written off last year. So really, the only assets they've got, and that's, that's fixed plus current assets, £300,000 cash at bank. So we can prepare these accounts under different bases, and the bases are dictated by what Companies House rules are. So anyone get any idea whether this is a large company, a medium company, or a small company? There we go. So its turnover is over £1 million a month. Any ideas? Small company, okay. So we're sticking with small. Let's go to the next one. This is Balderdash Limited. Exactly the same situation, but what happened is rather than the director taking the money out, who is also the only shareholder, every month, the last month, he didn't take his dividend until the following month. So the turnover's gone down. It's gone down from 15 million to 12 million. His balance sheet assets gone up by 20 grand because he took the dividend a month later, still 9 staff. So this is 12 million, £1 million a month. Any idea what's this one? Large, medium, small, micro? You think it's still small? Okay. So this is the rules at Companies House. So Companies House rules say a micro company cannot have a turnover of more than 632,000 annual turnover. Fixed assets and current assets cannot be more than 316,000, cannot have more than 10 staff. That's the definition of a micro company. Now, you don't have to have a director's report with those accounts, and it says no notes, but there's virtually no notes to the financial statements. Now, the key to this is you can breach one of those rules, which means you can comply with 2 out of 3. If you breach one, you're still a micro company. And a small company has director's report. It does have notes to the accounts, but basically you give more information at Companies House. This information is all at Companies House. So given what we've just said, any ideas what size of company that is?
Micro.
Micro. And it's a micro company because its turnover is more than 632,000, so it's failed that test. Balance sheet is less than 316,000, and it's got 9 staff. Now, the interesting thing about that is nowhere in that note will you see any reference to creditors. Companies House don't care about creditors for their definition. Fixed assets plus current assets is their definition. So that has got that's £300,000, less than 316. That one is a small company. So the first one was micro, that's small. And it's small, it's breached turnover because turnover is more than 632,000, and it's breached balance sheet assets. Now, you could say, well, why do I care? So just let me tell you why you care. So to start with, to give you an idea, we've got one client which is a subsidiary of a Canadian company. And they don't want to pay UK tax, but they want to pay Canadian tax. The question then is, where do we leave the profits? HMRC have this thing called transfer pricing legislation. So then you can get into all manner of problems justifying it. But you don't have to do that if it's a micro or small company. So I've got one client, it's a small LLP. Small LLP, in this case, he's got a turnover of £20 million. He's got 46 staff there, and 11 months through the year, he normally has about £6 million in the bank. The last month, we tell him to pay himself a cheque for £1 million. It's an LLP, so it doesn't give rise to any additional tax liability. That takes him down from 6 million to 5 million. 5 million means he's a small company. Now, why am I so interested in all this lot? Well, to give you an idea to start with, the current IR35 legislation says that if this guy, my gas contracting client, all his limited companies that invoice him, if he was not a small company, a medium-sized or large, he would be liable for deciding whether that subcontractor, that limited company, complies with the IR35 legislation, and if they don't, he's liable for it. That's how the legislation works at the moment. If it's a small company or a micro company, that legislation doesn't apply to them. So what you need to do is look at your accounts to see, A, whether you fall within those rules, and could you go down? Now, the idea behind it is if you can be defined as a micro company, you don't have to file a director's report. There's a maximum of 6 notes to the accounts, most of which a lot of businesses don't have to have, which means you don't sort of come up on the radar screen. So when I say the radar screen, the IR35, there's been a report on IR35, and HMRC said, look, we don't really know which businesses to pull up on IR35, but once we've got the accounts, we've got the information in front of us. If you don't have to file that information, then there's less to pick you up on. What I was saying to Mark earlier is you don't really want your head above the parapet. If you want to, you can, but you don't have to. So let's flip it a bit for something that may be more relevant for you. Let's just say I've got a company that's got £10 million of property. I get a return of 6% on that property. So that means my rental income is 600,000 and I've got 9 staff. What size of company am I going to be? Micro. Micro, because I've breached that, because that's £10 million. But I'm getting a 6% return on my 10 million, which means that is 600, so I'm within that, and I've got 9 staff. So that's a micro company. So suddenly, I don't have to disclose those information. Now, you could say, people say accountancy is a science, but I don't think it is, it's an art. So that same company, say the client said to me, actually, Chris, the bank want me to revalue that property. FRS accounts are done on a historic cost basis, so you can't revalue the accounts. If you want to revalue them, you have this, which is FRS 102. Financial Reporting Standard 102 dictates how we prepare those accounts. Financial Reporting Standard 105 dictates how we do those accounts. If we do these accounts, because we've revalued the property, so that we have to use this whether we like it or not, for a business that previously we know was a micro company. So we revalue the property, exactly the same set of accounts. You revalue the property and the fixed assets go up, and then we have a revaluation reserve. What you'll then have is deferred tax. So can anyone tell me what the current rate of corporation tax is? Can anyone tell me what Liz Truss has said the corporation tax will be April next year? 19%. The only problem is that legislation has already been put in place to say that the tax will be at 25% next year. So with those accounts, I'm going to do a deferred tax calculation. And deferred tax basically is, say the property we know is £10 million cost. If it's now got a value of, say, 20 million, I've revalued it up to 20 million, I've got revaluation reserve of 10 million. But because I've increased the value, I have to provide for the tax on that. But I'm not going to provide for the tax on that at 19%, I'm going to provide for it at 25%, even though there's no 25% at the moment, but that's what the legislation says, because it hasn't been changed. Because it's not law what Liz Truss has said, it's you go through a finance bill, then a finance act. So you've got to do that bit. So with the property, I saw a few shock and awe, you don't pay tax on a revaluation reserve. It's an undistributable reserve. You can't pay the money out. But you do have to provide for it in your accounts, because if you say my property's gone up £10 million, then you have to provide for the tax. If you sell it today for that money, then you would have a tax bill at 25% according to the legislation, even though there isn't a 25%.
So do you have to keep these reserves before you can distribute them?
A revaluation reserve is a non-distributable reserve, so you can't pay a dividend on that. Otherwise, everyone will be revaluing it. It's not realised. It's an unrealised figure, and what that means is you just artificially increased it, because next year it could go down again. So what I then thought is that, you can see that very well. I don't know if you can, sorry about that. Company's House, you can find any set of accounts you want at Company's House. It's fantastic. You can have a bit of search. So I thought, as we're in Essex, I'd try and find a set of accounts from Essex. And I thought I might get one, as we're here with Mark, might have one that he knows. So this is called a company for the year ended 30th of June 2021. It's called Amsvest Limited. Any ideas what? Give it the clue is the first 3 letters. Alan Sugar. So Amsvest is his limited company that invests in apprentice. So when they come in, he takes, I think, half a stake in all their limited companies, and this is his vehicle. The only trouble is, Lord Sugar, I think, he's run out a bit of money, and we'll see why. So this is the unaudited financial statements for the year ended 30th June 2021, and this is the, sorry if you can't see this at the back, but the directors are Lord Sugar, Michael Ray, and someone that's just resigned. And its registered office is in Loughton in Essex. And then you've got a balance sheet there, and the balance sheet says, you might not be able to see this, these accounts are prepared in accordance with FRS 102, which you'd probably agree with because you've got fixed assets there of just under £3 million. So that makes sense. So sort of, it's all looking good so far. Then you've got the notes to the financial statements. Now, the only trouble with this, you probably can't see this, but what this says is the accounts have been prepared under the financial reporting standard for smaller entities effective April 2008. Now, the only trouble is that's been surpassed. So that legislation is not relevant. The balance sheet said that it's been prepared under financial reporting standard 102, came in 2015. That went out in 2015, but that says 2008. So, and that's it. Let me go back to this one. That's all you can see on the accounts. I can't even see if it's right because the notes are wrong. The accounting convention doesn't even agree with the balance sheet. This is ripe for Companies House to have a look at it. Not that they do because they're undermanned at the moment. They're getting more resources. HMRC, I'd be quite interested to see what they think of that. So a lot of this is that you can't even do that if you wanted under proprietary software. This would have to be done on someone's typewriter somewhere, and it's a bit of a mess. But what I told you about FRS 102, 105, the government, probably in the guise of HMRC, have already said they don't like this, and they don't like it because they're not having enough information. So if you want to do, if HMRC want to give you a tug, do an inquiry, they've got less information upon which they can bear that, they can do that on. So the less information you give them, the less chance they've got of just pulling your name out of the hat. This is what I say to my son when January comes round, when we're pretty mad. I'm glad I learned about parallelograms in high school, maths. Instead of how to do my taxes, it comes in so handy during parallelogram season. Now, what you may have gathered, what I'm telling you, is a set of accounts is sort of a bit of an art, but this forms the basis upon which the taxation comes in. And therefore, you can have an accountant that does different sets of accounts based on virtually the same circumstances, but one of them you're sticking your head above the parapet, probably needlessly, and why not? So this is sort of what I think I do. Someone who does precision guesswork based on unreliable data provided by those of questionable knowledge. That's sort of what an accountant does. I don't sell the T-shirts, but they can think you can buy them somewhere. So that sort of gives you an idea of how it works. So I just thought I'd give you some background. Before we go into the tax, once the accounts are the basis upon which you send your tax, corporation tax, income tax, if it's an LLP, a partnership, to HMRC. This is the basis upon which you have a tax. Your tax bill isn't necessarily your accounting profit, but it forms the basis of it. So the important thing is if you don't get the accounts right, the rest of it can all be a bit screwed up. So that's sort of how it follows on. Is that all right? Gives you a bit of a head start anyway before we go into our questions. So has anyone got any questions on that bit? Or is it just too much of a whiz? So we'll take some questions in a minute when I think Asia's going to take there. But thanks very much. Oh, sorry.
I've not studied this. I don't understand the background, but there's been some cases again about this loan back thing recently, and there's supposed to be some campaign going on in the public because people are being pulled up for loan backs, like you said, the Rooney case. Have you got any information about that?
So what you've got to bear in mind is that HMRC say, look, if you wanted to borrow money from a bank or a building society, they would charge you interest. If you borrow it from your own company, there's really only two ways of taking it out of your company: by dividend, if you're a shareholder, or by salary. If you borrow money from your company, then what's happened is you've avoided dividend tax and you've avoided PAYE, and you've also, more importantly, avoided employers' NI, because there's no national insurance paid on dividends. So therefore, we want to make it penalising, so we're going to bring in a tax rate, and we're going to sit on that tax. It's not a tax bill, but we, HMRC, will sit on that until 9 months after the end of the year when that loan is repaid. So the company has to pay that money back. So if the company lends me £1 million, it pays 325,000, 32.5% of that figure, to HMRC, and they're going to sit on that money till the loan is repaid in full. And the company has to charge me interest, otherwise there's a benefit in kind on me receiving a loan with not paying interest.
So it's the benefit in kind that they're in dispute with
Well, there's two things. One, the Section 455 tax, and one, the interest on the loan, which add up.
Section 455 come after Jimmy Carr, is it that?
So what Jimmy Carr did is he set a company up in Jersey, and so Jimmy Carr did a gig in Bolton, for sake of argument, and they said, how much? And he said 30 grand. So they said, okay, but I invoice it through my limited company. My limited company is based in Jersey. So they paid the money to Jersey. Jimmy Carr then took a salary from the Jersey company of 10 grand and borrowed £1 million from his Jersey company, which is basically what they've done. That's Section 455 tax. So then what happened is that because it's a Jersey company, the idea was that HMRC wouldn't know about it because he'd just taken a loan. But he got tripped up by that, and he got caught out by the legislation. And then he ended up paying it all back with interest and penalties. So what you've got to be careful of is, at the moment, interest and penalties are the bit that get you, and they could probably be more than double what your tax bill is, unless you can mitigate it down. So it can add up sort of pretty painful. Okay.
Great, so we've got Shaz here now. Chris, myself and Shaz are going to answer any of your questions. You can, it doesn't have to be about tax, it can be property based as well, but I suspect there's going to be a load of property stuff that interweaves into taxation as well. So fire away, this is your little mastermind session. Hi.
Hi, thanks everyone. My question is, with all these different structures and stuff, like, when's the right time to get this set up? Do you stop and do a bunch of work up front?
Yeah.
Or is it like a right, because there's obviously costs and different things involved, and at different times is the right time to issue shares, and when things have no value, you want to do one thing, and when it's got value, and it can so easily just become like, crap,
Well,
now what?
Chris would say straight away.
Yeah, I'd say yesterday, actually.
Well, I can't see you yesterday, can I?
I would probably say wait until there's some profit and you're actually making some money and you've basically got a tax problem, and then I usually send people to Chris to sort them out, or Shaz. Do you see what I mean? Clearly, if you're going to go and buy a big building or you're going to go and buy a big company,
Sit down.
you're going to want to go and see someone like Chris.
They probably can't see us.
Because, it's stamp duty and you can enter it the wrong way. But if you've just got a sort of small business, do you know what I mean? You're just starting from the ground up, you're not profitable yet, maybe you'll be paying too much in fees versus what you're saving in tax. Do you see what I mean? So it's quite simple. Once they start nailing you, and they will, they'll absolutely nail you. And, you'll be paying corporation tax, you'll be paying, probably drawing a salary out, you'll be getting business rates, they'll be getting you at every angle. It will be cheaper to go and see a proper accountant to not get rid of it all, but to manage it and reduce it. Yeah.
So let me give you an example. Say we had a client that came to see us, and he said, I'm going to sell my trading company. So I said, oh, fine. What's the shares? And he said, well, I own 100% of the shares. I said, does your wife own any shares? No. How much are you going to sell it for? And he said, well, I'm going to make a gain of £2 million. So he's a trading company. In the old days, you could claim something called entrepreneur's relief. which was a limit of £10 million taxed at 10%. Now you get BAD-R, business asset disposal relief. That's also at 10%, but only on £1 million. So I said, well, is your wife working in the business? She's an employee. So if she had 5% of the shares, which is the rule, 5% shares for 2 years in a trading company and employee or director, she can get BAD-R. So at the moment, he's got 100% of the shares, and that has to be in place for 2 years. If he then sells this business within 2 years, she won't get BAD-R. But he could have had £1 million of the gain, she had £1 million of gain, and they only pay 10% on 2 million. Now she's going to pay capital gains tax at 20%, and he's going to pay 10%. Now that advice should have been 2 years before you sell it. And you could have some advice, I know, inheritance tax advice should be 7 years before. But if you don't know, you don't know.
Constant conversation, basically, with your...
Well, I mean, I think it's Donald Rumsfeld that says there's the known knowns and the unknown knowns. And there's a lot of stuff that you don't know. Well, that's when you need to take advice. And it may be that the advice is relatively simple. Can I make myself a trading company? Because if it's not a trading company, investment, if it's just passive investment, you won't get BAD-R either. Can you make it trading? And then you need to sort of think about that. Do I want an LLP rather than a limited company?
Hi, Chris and Shaz.
Hi.
How are you guys, if you don't mind me asking, passing or structuring inheritance for your kids? Because you've obviously got lots of business assets, properties. You know, how are you doing that, if you don't mind me asking?
Oh, it's easy. One of my clients came to me and he said, don't want to talk about it, I'm not going to pay inheritance tax. I said, oh, brilliant. How'd you do that? He said, I'm leaving it all to the wife, so I never pay anything. And I said, well, that doesn't quite work. What about when she dies? So I would say that my business is a trading business. So upon my death, I would claim business property relief, which means it's exempt from inheritance tax. So what you've got to do is pick your reliefs and make sure you take advantage of those. Make sure that I've got any of my assets that I can write into trust, pensions, life assurance, things like that, aren't in my estate. I can write them out so then they don't hit 40% tax.
Yeah, I like that. I think the challenge that you talked about, Mark, is in property, you get to a stage where you've perhaps been on a few courses or you've heard Mark or somebody else talk about different property strategies. And let's say you've got one, so I'm answering your question, by the way, and you've got one particular company and you've got, let's say, 15 buy-to-lets in there. And then all of a sudden you hear Chris and he talks about having a trading business, and then you're thinking, how can I turn my business into a trading business? And how can I add a holding company on top so I can move money around and add different shareholders? The problem with doing it later on is it's going to have a tax consequence in terms of either you do a share-for-share exchange or you're selling assets from one company to another, and that's going to cost you quite a bit of money. So the answer, which you probably won't like, is at the start you've got to spend quite a bit of time thinking about where your business will be in the next 5, 10, 15 years' time. Now, I appreciate what you think you're going to do today in 10 years' time isn't going to be what you're going to do in 10 years' time. But if you can build a structure which is quite flexible, that's going to give you the ability to change things around. Whereas if you do it later on, once you have a business and you're making profit, you'll have two things that you're going to have to think about. One is pay accountants a lot of money to restructure your business, or pay a lot more tax to get to where you want to get to. So I think you've got to do the deep, hard thinking at the start to save you money in the long term. To answer your question, Shamila, isn't it? What I think there's 3 or 4 things you could do. If you're doing what Chris does, obviously you've got a trading business, then you can claim BPR. The problem you have is that only applies to trading businesses. And if you've got buy-to-let properties, you're an investment company. So you ought to be thinking about trusts, as Chris says. You ought to be thinking about adding your children as shareholders, having possibly different classes of shares. And you, at the same time, if you haven't thought about all those things, then you need a life assurance policy, which is going to cover your inheritance tax bill at some stage in the future. So again, it comes to the thinking at the start in terms of what do you want to do with your assets when you get to a particular age. And the million-dollar question, I guess, is are you comfortable in giving away some of your assets and your income to your children? Okay, because if you do, then you may lose control. You're definitely going to lose the income, so you might get to the age of 65, 70, or however long you live, and you've got less assets, less income, and you can't survive. So it's catch-22 in terms of how much money do you think you'll need in the future, and how much are you willing to give away to your children, who you don't know how they're going to look after those funds in the future, if that makes sense.
That probably comes back to a conversation Chris and I were having earlier about whether the kids know you've given it to them or not. Because I'd probably happy to give it to my child if he didn't know I'd given it to him. Because then he wouldn't sort of be blowing it, and he'd also think he wasn't going to get anything, because that's what I sort of want to get him to believe, because hopefully then he'll work hard.
Yeah.
I mean, you guys probably got a few ideas around how you give them stuff without them knowing they've got it.
Well, I had a counsellor colleague of mine, who you may know, by the way, and his dad was pretty wealthy, living in Newborough, and when he passed away, he's found out that his dad left him, I think, about £40 million.
Really?
Which was good for him.
And he had no idea that he was getting any of that?
No idea.
Did he even know he had it?
No, he didn't.
What?
I know.
Well, he didn't know his dad had all that money?
No, he didn't. But to answer your question in terms of, okay, and this guy's about 50 years old, so what's the first thing he does when he gets all that money? He buys, I think, a £5 million yacht. Okay, so,
What?
and this guy's 50 years old.
But his dad, he did a very good job then, coaching him into what?
Well, when you get money for free, Mark...
Flies, floats... So,
that's what you're going to do. Yeah, so.
Rich dad, poor dad.
Yeah. Mark.
Hi, Shaz. Hi, Chris. Thanks, Mark. So, Mark Lloyd, everyone knows my name, I think. I wanted to ask you about a situation that I made a mistake with, and about life insurance policies and estates. I had my buy-to-let portfolio, and I put, I fell for the broker's commission on putting a life insurance policy on each of those mortgages. And what I realised was I hadn't put them into trust. I'm getting rid of those products now. I think it was a question I asked a while back, Mark, and you explained the reasons why I don't need those life insurance policies. So thank you for that. That's very useful. And the total portfolio is worth 3 million. The life insurance policies are worth 1.5 million. I wanted to ask about where HMRC what happens when you die and you've got these life insurance policies, and the advice I was given that I made a mistake. I should have put the life insurance policies into a trust, or put my policies into a trust. Otherwise, HMRC say you've got a £3 million portfolio, you've got £1.5 million worth of insurance policies. That's your total estate, and then they will keep. I have no children. I'm not married yet. It was just my father. My father will be faced with having to cash out 1.5 million to get the money back from my portfolio, really, or my estate. I don't know if I've confused everyone, but basically, insurance policies are added onto your estate. Is that correct?
So, with the life assurance, what you can do is, I don't know if it's who is the beneficiary of the life assurance at the moment? Is it a company?
No, I've got
you personally.
It's me personally,
So,
but I've got no dependents at the moment.
But you can write that in. You should be able to write that into trust,
Right. Okay.
So that it goes directly to whoever you want it to go to.
Yeah, it'll go to my
outside
dad.
your estate.
Yeah.
So then the question is the rest of your
and
estate
tax-free, because it's outside the estate.
Yeah.
Okay. Thank you.
And is the rest of it £3 million in residential property?
Yeah.
All residential. Okay. So and does that have mortgages on it?
Yeah. I'm leveraged 50-50.
Okay. So you got £1.5 million of assets.
Yeah.
Okay. So do you own a residential property?
I'm just completing on one at the moment. Yeah.
Okay. So there is what's called a residential nil rate band, but I think you have to leave that to your heirs, and you haven't got any.
No.
So that means you're probably, IHT exemption is probably going to be 325 rather than 500,000. So that means that you'll get a £325,000 exemption, but then the balance of your estate is going to be taxed. You've got no special exemption. So unless you start giving it away 7 years before you die, and if there's no business property relief because it's all residential property, and it's not agricultural property, so the chances are you're probably going to end up paying inheritance tax at 40% on the balance.
That's my dad will be paying inheritance.
No, your estate pays it.
Your estate pays it.
So,
Okay.
but say you started, you could gift shares. Could you gift shares up to 325?
Yeah, but he owns it in his own name.
But you
Yeah,
probably,
the property in
you
your
probably
own name.
won't be, will it? The property's owned in your own name, are they?
They are, yeah.
Surprising, is it?
Well, I wanted to enjoy my lifestyle, and so I have a lifestyle portfolio and then building a legacy portfolio,
Yeah.
and I was going to put the legacy portfolio in the limit. That's
not,
going to
not an issue for Section 24?
Well, it's just that I didn't want to take money out to service cars and do this and do that or do that. That's why
You do want to take money out?
I do want to take money out. And
well, it's a problem with a limited company,
yeah,
isn't it?
and if something needs to be done, I don't want to be having to pay corporation tax and pay tax on whatever I take out. So for me, I set up my vision to have a lifestyle portfolio, then a legacy portfolio of hopefully commercial property. That's my plan.
But you're not offsetting all the mortgage interest, I presume?
No, that's right.
But it still sort of works, does it?
It still works for me. I mean, I still like practicing as a surgeon. I love that. That's my passion. I'm never going to give that up, I don't think, because I love it so much. And so I just thought it's nice to, but I've backed off and I'll become a low-rate taxpayer, hopefully by, when I turn 50 next year, because I'm going to drop back on, I've got a couple of days of PAYE I still do, which I enjoy because it's what, I enjoy the work.
I suppose if you took that income from operating as a surgeon into a limited company, then...
But you can't, it's on PAYE.
Well,
the NHS, aren't you?
Well, what I do is I've left the NHS, so I work for a private healthcare company 2 days, work privately on Harley Street 3 days, got my portfolio operating in the background, generating income.
But would they let you invoice through a limited company? They're probably going to hit by IR35, so they wouldn't let you do
Yeah,
that.
That's going, isn't it? Liz is getting rid of it.
Well, yeah,
No?
but she says it is. She also
Not
said
yet.
that
She doesn't know
get rid of
what she's
45%
doing,
tax.
does she?
The idea is that
God.
the IR35
I was
stuff,
so
I'm telling you
excited about that. In our office, we have so much hassle over IR35. And I just walked into our head of account. We looked at each other. She's like, IR35's gone. And now, of course, 25% corporation tax. You can't believe anything she says, can you?
No, you can't.
Sorry.
But sorry,
Thank you.
Don't get me started.
Isn't your life assurance going to pay for the IHT?
Sorry, Chris, I couldn't
Isn't
hear
the
you.
point about the life assurance that your dad will get? Won't that money, upon your death, won't that pay your IHT liability?
It will.
Isn't that the whole reason for doing it?
Say that again. Sorry.
Upon your death, your life assurance will pay out a lump sum.
Yeah.
And isn't that the cash your dad's going to use to pay the estate's liability to IHT?
Well, I was told that the advice I was given by my financial advisor was that because of the mistake I'd made of not putting my insurance policies in trust.
But you could take new ones out, or could you retrospectively write them into trust?
I don't see why you can't.
Yeah, that's what that's why I just want to double check
I've done
coming
that.
here.
I took some out. They weren't in trust because no one really told me to. I didn't ring Chris up, and then I realised, and I got it written into trust. Rob, I've got one for the benefit of Rob. Rob's got one for the benefit of me. It's different. It's just because if one of us dies, there's a problem with the business, and it just gives immediate cash. And it gets paid out tax-free as well.
So sorry, what Mark's saying is quite common. So say there's a firm of accountants, 5 partners. The idea, if one of them dies, how's the other 4 partners going to buy his estate out for his
right.
share?
That's the same
So
problem.
then what happens is they cross-insure their lives. The money that comes out from their insurance gives them the cash to pay for his stake in the business.
Thank you.
That's why
You bite off the family, yeah.
Thank you very much, guys. I really appreciate that advice.
You might just want to look at those policies because as you get older, they get more expensive.
Yeah.
But not for new ones get more expensive often.
Yeah.
But the rate that you're now paying is probably calculated at a rate which when did you take them out? When you were a lot younger?
No, I rebuilt my portfolio in 9 months. So I had one portfolio, and then...
How long ago?
So that I sold that. I had that for 3.5 years.
So when did you take out the insurance policy?
In the last 9 months.
Oh, okay. So the cost of getting a new one's probably similar.
Yeah,
then.
yeah.
But you know, after taking one out when you're 60 is so much more expensive than taking one out when you're 30.
Okay.
And I think they have to keep the premiums at a certain at the same level. So if you've got old ones, they can be worth a lot of money, and you don't want to cancel them. See what I'm saying?
Thank you. Yeah.
Maybe not in that instance, but
that's good. That's reassured me that I'm not going to make that mistake again. But thank you.
To move the insurance into trust, do you have to change the insurance? Or
Do you want to just use the microphone?
If you want, do you need to change the insurance policy altogether, or just change the?
From memory, I don't think we did. I think we wrote it into trust after taking the policy out, and you guys think that's fine.
Yeah. I just did it over the phone with one of my life insurance.
This is my understanding as well.
They sent the trust documents out, the insurance company, and I just wrote them out afterwards. Yeah.
Thank you.
How many properties do you own, Mark?
So I've got 6 buy-to-lets, and then I've just sold a residence and I'm buying a new residence.
So you can possibly think about incorporating, which is what Chris talked about earlier in terms of the Elizabeth Moyne Ramsey case, which I know we talked about, and move your properties into a company and then form a trust, and that could possibly, after 7 years, help you mitigate the IHT liability. So that's something to think about. If you don't want to do that, you could go down the route of serviced apartments, and that could possibly help you claim BPR, but you've got to offer a high level of service, and that's not easy to do, by the way. So you've got to be as close to a hotel as you can be, as opposed to just being service accommodation.
Thank you, Shaz.
But you might not want that headache, because I know you're quite busy doing your routine work as a surgeon.
Yeah.
Okay. What kind of surgeon are you?
A plastic surgeon,
Oh, yeah.
super specialised in craniofacial,
Yeah,
and then
okay,
super
oh.
specialised making ears.
Yeah, that sounds really simple.
I got intimidated listening to you do all that when you were especially up on that crane. I thought, God, I hope am I going to end up being a plastic surgeon who ends up falling off a crane as a commercial to residential masterminder? But
You might get a discount on your fees.
yeah. So I was like, oh my God, that's the most scary thing ever. So for me, surgery is fine, but seeing you up on that crane was pretty scary as well. So
It was pretty scary climbing up there with the wind going.
yeah, that's.
Thank you, Chris. Could you please expand a little bit more on the Resnan Dam and the Portugal-Dubai scenarios, and how easy is that exactly, and is that available for everyone?
Do you fancy going abroad?
Very much.
Whereabouts?
Oh, Portugal, Dubai.
Okay. So the reason I say is it depends, because obviously there's... so Britain, because we're an island nation, we did a lot of travelling. So we had trade negotiations with a lot of countries, and those trade negotiations manifest themselves into double taxation treaties. So those treaties dictate where things are taxed. And interestingly, some of the older countries like India and Pakistan have much better double taxation treaties for the residents of those countries that actually override some of the UK tax legislation, particularly for IHT tax. If you go to someone like Portugal, Portugal has brought in this non-habitual residence, see, that sort of overrides the double taxation treaty again. But the thing about that is you can pay a lump sum to Portugal, you can go there, you can pay no tax in Portugal, and you'll pay no capital gains tax and no inheritance tax. But what you've got to bear in mind is that there's this thing called UK situs assets rule. So I'm guessing, were you born in the UK?
No,
Where were you born?
Latvia.
Latvia?
Yeah.
Okay. And your dad?
Same. Everyone's from Latvia.
Okay.
I just moved here 5 years ago.
So then the question for you is, where is your heart? So with Robert Maxwell, I explained earlier, born in Czechoslovakia, his avowed intent was to be buried at the Mount of Olives in Israel. So his heart has never been in Great Britain. His body has, i.e. he's resident here at Headington Hall in Oxford. But he wanted to be buried at the Mount of Olives, which is where he was buried. So therefore his heart has always remained out of the UK, so he could maintain a non-UK domicile status. So then I'd say to you, you should have a Latvian will, UK will. Where do you want to be buried? I want to be buried perhaps in Latvia. And then it may be that you'll then be subject to inheritance tax on your UK situs assets, maybe UK property. So you may have a UK IHT liability and possibly Latvian. I don't know what the rules are in Latvia. But the point is that, anyway, with regards to you, if you move to Latvia today, then you're non-resident and probably non-UK domiciled. But you'd still, if you have UK property, that UK property is still subject to UK tax because that's where it resides. And also what you're going to bear in mind is from 2015, if you're non-UK resident, you'll have a CGT charge on the value of the property when you come to sell it. So prior to that, non-UK residents didn't have a UK liability on UK property. Now it's valued at 2015 or a later date if you exit the country. And then you'll pay UK capital gains tax even if you're not resident. But what you'd probably be doing is you might want to ring fence some of that future gains.
So, for example, if I live here, but I do something that's online or consulting, things like that could technically be done online or pretty much anywhere, how do I want to be establishing some sort of residence somewhere else and then process?
Sorry, what's your name?
Donna.
Right, Donna. What I'm going to do is I'll send you a bill, and it's going to be from Wilkins Southworth BVI Limited. The only trouble is that because it's a BVI company, it's pretty irrelevant because I'm sitting in London. So I'm going to pay UK tax even though it's an overseas company. So if you sit in the UK doing consulting, but you invoice that through a Latvian company, anything like that, it doesn't save you UK tax because it's managed and controlled from the UK. So if your duties are performed in the UK, the fact that your customers may be paying to an overseas company doesn't necessarily avoid UK tax.
Well, that's actually exactly what I mean. What if I am traveling half of the year or anyway a big chunk of the year and I'm performing the consulting or whatever else my businesses are online whilst I'm abroad as well? How does that work?
Well, then it comes down to the residency rules, whether you're deemed to be UK resident, where your property is, where your main organisation is. There's tiebreaker clauses in the Double Taxation Treaties.
Thanks.
So you can spend a certain number of days. There's a sort of tick box system.
Yeah.
Or is it between is it about 30 days up to 120, depending on how much stuff you've got here? You can be in this country for, but the rest of the year you've got to be gone.
So where my heart lies come into play?
That's for IHT, not for income tax. Yeah,
okay.
That's right, isn't it?
Yeah.
Your domicile's linked to
Yeah.
IHT, isn't it?
Okay.
So basically we're looking at three things here: capital gains tax, inheritance tax, and income tax. So for an income tax purpose, if your duties are performed in the UK or corporation tax, it doesn't matter whether you pay your cheque to Latvia Limited or something, because your duties are performed here. What you're talking about is trying to make yourself non-UK resident. And this is fraught with difficulties. So there's one case, a guy called Gaines Cooper. His dad was an inspector of taxes, believe it or not. And he do you remember the old days, the slot machines in the pubs, loads of those? And he had all of those, and he became very, very wealthy. So what he did is he took himself over to the Seychelles, and he said he's non-UK resident. The only trouble is, I don't know if you can physically see me, but HMRC said you've got 1 foot in the Seychelles and 1 foot in the UK, because you're still a member of the Windsor Polo Club, your son goes to Eton, so I don't think you've exited the country properly. Therefore, you're going to pay UK tax on the whole lot. Now, this guy is so rich that he's gone through every single court you could dream of, and he's still appealing, and it's cost millions and millions. But if you read the case, he's lost decisively because of that. Another one, has anyone heard of John Hargreaves, runs Matalan?
So that doesn't help you, even if he spent only 2 weeks in this country, because he's got so much here.
He hasn't exited himself.
Yeah.
And with John Hargreaves, he went to Monaco. He's the Matalan boss. And what happened is he still wanted the best of both worlds, which a lot of people do. But he came back too much, and I think for all his family ties. And he got advice from PwC, and he lost his last case.
They told him he could do it, though, didn't they?
They told him he could do it, and it didn't work. And you've got to be so careful with this stuff because there's so much money at stake that HMRC will check it. And if you're not sort of tickety-boo, it ain't going to work.
If you sell everything, though, and you don't necessarily have to sell all your properties, but you get your own home, You get rid of all your subscriptions. It probably doesn't help if you've got kids in school here. There's a whole list of stuff
his
you've got to
son
get rid
was
of. Isn't
at
there?
Eton, and he was sort of a member of Windsor Polo Club. So the point is, he hadn't severed his ties to the UK.
But
So
if you get rid of it all and you stay out long enough, there are quite. I mean, I know an accountant that does this. He does our capital allowances. He lives in Portugal. He does that, and he just flies over, does the reports, and then clears off again. And seems to work for him fine. But he's really rigid about how many days he is here. And you can get pre-approval, can't you, with HMRC? Put the tick box in, and they say how many days you can be back for.
Some of these cases are amazing. There's one case where a guy said, I'm non-resident. And Private Eye calls this voluntary tax, because they say, well, now you're going to know if they don't stamp your passport. And he said, no, I was only in the UK for these number of days. So then what they did is they actually got all his bank statements, and they found that he was withdrawing cash from Green Park ATM on days when he said he was in France. And they said it was rubbish, a whole lot's rubbish.
Your mobile phone and all your bank statements, your credit card statements, obviously you need to link up with the days you're supposed to be out.
Yeah, and I guess the other challenge you have, and I'm sure Chris will agree, is that those rules get changed quite often because people abuse them. And you're not going to like the answer, Dana, by the way, and Chris is right again. People want all the benefits of being in the UK, but don't actually want to pay the taxes that come with being in the UK, if that makes sense. So I think you ought to think about, do you really want to be in the UK, or do you want to be outside the UK and not be within the scope of tax? And if it's, I want to be in Dubai or Portugal or wherever, then it's fine. But if you want to do business in the UK, and if you have children, or if you're going to have children, they're going to be at school here, and you want other benefits in the UK, then as Chris says, I think trying to do the planning is going to be complicated and expensive, and whether you go to a small firm of accountants or PwC, as you've heard, sometimes they can get it wrong too.
They often do get it bloody wrong.
They do.
And you remember that Mishkonda Rare with, someone that we know.
I use them as well.
Yeah, but they screwed this one up.
Yeah.
Someone that Chris and I do. I mean, just because they got all the big names, I don't know. They're not always right, are they?
Yeah. No. I mean, we had one client that they said that we want to exit to Jersey, and we looked at it and said, it won't work. They said, well, don't worry, we're going to find a firm that will make it work. So they went away, and they went to a big firm, and probably about 4 years later they came back. They lost everything. They sued the firm. The firm were a big firm, so they spent a load of money, and they ditched them and came back. And sometimes people don't like bad news, but if that's the law, you can't I can't change the law for you. I'm only telling you what the law is. But having said that, what you've got to bear in mind is HMRC have their own manuals, but those manuals aren't the law, that's their view. So there's case law and stuff that overrides it sometimes, and just because, like, there's one case they had extra statutory concessions, and extra statutory concession is dictated by HMRC, and they'll say, this happens. And a guy took it to court, and the judge said, well, this is rubbish. Just because you say it happens, that's not the law. That's just what you've printed as an extra statutory concession. But the law says this. So you've got to sort of have a healthy disregard for HMRC, but by the same token, you're subject to judicial precedent, case law, statute, etc. And your guidance is weaving a path between that lot. And if the guidance isn't what the client likes, well, that's still the guidance.
Because your letters to HMRC are all really polite, aren't they, Chris? And really sort of, you pussyfoot around them, don't you?
And I guess the other challenge with that, I'm sure those of you who have come onto any of my courses will recall, most accountants, unfortunately, look at HMRC's website and then give you advice based on that, or they'll send you a link to HMRC's website and say, go and read this particular article by HMRC, okay, and follow their guidance. And of course, HMRC, as Chris says, don't write the rules. The rules are written by Parliament, and HMRC are going to interpret those rules, more often than not, in my view, by the way, to benefit them, because their job is to collect tax, so they want to get as much money as they can into the exchequer. So you want to make sure you have a tax advisor or an accountant who has experience of understanding what the law is, as opposed to what HMRC are telling you to do, Dana. And my advice to you would be, because we've spoken a few times, is I think, and again, Chris might not like my view now, I think people sometimes spend way too much time thinking about how can I save some tax somewhere, okay? And as a property investor, I think you should be spending that time thinking how, if I don't like my tax bill, for example, let's say it's £100,000, how can I do another deal, or how can I save money with the stuff that Mark talks about, okay, and make that money so that the tax is being paid through the next deal or through the savings, rather than thinking I'll move to Portugal, Dubai, here, there, whatever. I think personally that's going to suit you better. You might not like that, but
Loads of people end up moving back because they realise they don't actually like the place that they've had to move to, and they can't see their family, and they can't. So you do it for a while maybe, and you test it. I mean, there's other people. You know, in the pandemic, I know a few that went to Dubai to test it because they could, because there was nothing else to do, was there? And actually, the two that I can think of, they're loving it, and they've just stayed. So it works, but it doesn't work for everyone, does it? You know, I got a child. I'm not going to be able to just clear off until he's older. I do quite like the idea when he's older, but I can't at the moment. So they've got me in their net.
For me, I definitely see UK as home, and I really love it. But at the same time, I also very much like sun and warm weather. So I would
Me
like
too.
to.
All winter. I'd rather be gone. Yeah.
Yeah,
Yeah.
and I don't have kids, so
Yeah.
I'm thinking how can I maybe structure the year in a way that I can actually, you know, maybe be a third of the year here, half of the year here max, and then be somewhere else.
It works for some people.
Henry?
Can I ask a simple question? How do I know, well, tax law is so convoluted and property tax rules are really messy. Property tax rules are really messy. How do I know if I have a good tax advisor? How do I know if I'm getting good tax advice?
Well, I think the first thing you have to do is, I guess, find out if they are qualified to give you tax advice or not. Because when you go to buy a property, you go to a solicitor, they have to be regulated in order to use that title. With the word accountant or tax advisor, anybody in this room can claim to be an accountant. So you need to make sure that A, they're qualified and regulated, B, find out how much experience they have of doing the thing that you want to do, for example. So if you wanted to work within the world of property, you talk to Chris, you talk to me, and see how much we know about property and how many clients we have in the world of property and whether we invest in property ourselves. And you'll quickly gauge that by asking us those questions. And then understand how much expertise they have on that particular question. So I don't specialize in inheritance tax. I don't assume you do, perhaps. Chris, you might do, by the way. But we have people who are experts in that particular niche or area who will then be able to advise you. So it's asking the right questions and perhaps asking them for case studies, testimonials, and understanding how much they know. And then, of course, I think the most important thing is reading up yourself and just basic stuff online, just reading, just to have a basic understanding, so then when you ask them questions, you'll be able to gauge whether they know what they're talking about or not. But because it's very difficult for you to sit in a room and try and gauge how much Chris knows and how much I know about a particular thing, because we might be pretty good at talking about it, but we might not be that deep in terms of our understanding. So it's difficult to gauge expertise. But if you ask the right questions and speak to maybe 2 or 3 different people in terms of 2 or 3 different tax advisors, you'll be able to have a good grasp in terms of who knows how much. Yeah?
Most of the time, I only take people through recommendations. So if I know that person has been doing what they're doing for a while, you know, and they're successful and I trust them, then I'll usually take a load of recommendations and I'll just keep swapping stuff with them. So I have a few mates like that. If you know, like when I was building that building, I needed loads of professionals, subcontractors, whatever. I've got a couple of mates who built buildings like that. They gave me loads of them, and all the guys that referred me pretty much were great, you know. And the same thing, you know, I ended up building these things myself. So you know, I've got a reasonable idea of a load of stuff. They ring me up now. I send them all, you know, all my contact, everything they need like that. That's how I'd get a lot of mine. Because it is tough, isn't it? You go into a new area, you don't know what you don't know, so you don't know if someone's in it. They say they're great, but you've no idea. So, yeah, I don't take recommendations from people who are not doing what I want to do. Do you see what I mean? Or people will give you recommendations all the time, won't they? But if they're not actually doing what you want to do, then I just ignore them.
Hi there, it's Vince. We brought it up yesterday. Demographically speaking, there's a lot of landlords that are now reaching a certain age and they've got property in their own name. How would you advise them to basically make their exit if they were selling the property on, but it's held in their own name currently, to make it as tax efficient as possible so they don't get the full hit?
Is this residential property?
Yeah. Yeah.
And is this owned in their own name or via a limited company?
Own name. Because if
So then what some people do, they take advantage of Elizabeth Moyne Ramsey, which we mentioned earlier. They might want to put it in a limited company. And generally speaking, the way that worked is that if I've got one residential property today and I set up a limited company and I move that property, I gift it, sell it to my limited company, I'm going to create a capital gains tax in my name, and that capital gains tax on residential property is going to be assessed on me at a rate of 28%. I've got some clients with 60 properties, and the question is 60 properties a business? It will never be a trade, and a trade is a definition that it won't meet, but will it be a business? So Elizabeth Moyne Ramsey was a case of a lady had a property in Belfast. It had 10 rooms, 5 rooms were being let out, and she said that her and her husband spent 20 hours a week working on that. They mended the fence, they took out references, they cleared out all the rubbish, and the question is, are you conducting a business? And so she lost at the first tier tribunal. She lost because the judge said it wouldn't qualify for business property relief. Now, business property relief is an inheritance tax rule, not a capital gains tax rule. Her son then went to the upper tribunal, and he took the case on her behalf, and that was before a judge called Judge Berner. And in that case, what happened is that the son said, well, these are the activities my mum and dad perform, and therefore, because there's 5 let properties and 10 total properties, we think that's a business. And Judge Berner said that business property relief would not be relevant, which is why they lost in the lower courts, because you don't need to consider inheritance tax rules. It's a capital gains tax, and should you be able to claim something called Section 162 incorporation relief, and if you can, you're moving the properties into a limited company in exchange for shares, in which case you don't trigger a capital gain. If you did that, and you might want to go through an LLP first to avoid an SDLT liability, and then you get Section 162 incorporation relief that avoids a capital gains tax liability in receipt of shares, then the question is whether you then ultimately want to start divvying up some of those shares amongst family members.
And the threshold's probably about 5 properties, something like that?
Well, the point is that you used to get advanced clearance. You don't get advanced clearance anymore.
You got advanced clearance
for us,
yeah.
So
that's where you write to HMRC and you say, this is what we're going to do. And they don't quite give their blessing, but they sort of go...
They used to, don't you? When they're not,
they sort of go, we agree with this approach.
Yeah.
So we got that in the old days.
Yeah.
And then what happened is that you may recall we had an HMRC inquiry 6 years later.
Into our transaction.
And we got this bit of paper and said, where you go?
Well, you didn't. You made them find it themselves. You kicked them around the hall for about 4 months, and then eventually they found it, didn't they? And then sort of,
Yeah, and then it went away. So then the point is that what you could actually then consider is then you want to sort of pass things through the family members. Another way is if you didn't meet the Moyne Ramsey criteria, whether you want to give a part of your property. So some people say I own one property and it's worth a lot of money, whether I want to give 20% to my son, 20% to my daughter, over a period of time to spread out the gains.
Got it. Okay, thanks.
But to add to that, it depends what that person wants to do. So if, let's say they own 2 properties and the gain is £200,000 per property, and that's £400,000, and they want to use those funds to pay off the mortgage on their own house, or they want to move abroad, then if they obviously incorporation isn't quite going to work there with the Section 162. But if it did, for example, when they sell the properties to the company, the money's stuck in the company. So if they want to use those funds personally, they'll have a tax liability. So it depends on how many properties they have. If they've got 1 or 2, they could possibly think about running serviced apartments for 2 years, and as Chris talked about earlier, they could then claim entrepreneur's relief, which is now called business asset disposal relief. So it depends on the size of the portfolio in terms of what you could possibly do to reduce capital gains tax.
Got it, thanks. So basically, the landlord has, say, for example, very simple, he has one house in his own name that he lives in with his wife, and then he has another house that's his rental property, just very, very easy. That one's a rental property. Then both of them are held in his own name. Put that into an LLP, then LLP move it into a limited company. Obviously, it takes a little bit of time, but get it into a limited company as the ultimate kind of end, and then from there.
That's not going to work because you've got to demonstrate, as the rules stand right now, that you spend 20 hours in your business, and having one property, I think you're going to struggle unless you've got one property, which is an HMO with, say, 15 rooms.
HMO with 7.
Yeah. Well, I think managing 7 HMO rooms is as much work as managing 7 single lets.
7, you might. What do you reckon, Chris? Would 7 work?
So your first property, forget about it, because that's covered by principal private residence relief. So you've only really got one residential property. If you could put up an argument, it's just harder if there's only one property. And then you're never going to get advance clearance. So what you can do is do it all, send your tax return in, and just cross your fingers and see if they pull you.
How long have they got to pull you?
Well, as long as you make full disclosure, then they've got 12 months after the end of the filing of the tax return.
As long as you disclosed everything and did everything properly.
Okie dokie. Got it.
Any more for any more? I think they all want lunch, Mark, by the way. Happy to. Faros.
Actually, going back to the company loan. Yeah, the company loan. So if you, hypothetically, you took the loan halfway through the financial cycle and paid it back within, did you say is it 9 months?
Within 9 months of the end of the year.
Right.
So say you take it out in June, your year ends December,
Yeah.
and you pay it back before the following 30th September, then you haven't failed the test. So the test is that has the loan been repaid within 9 months of the year end? So you took it out in June, your year end goes up to December, so 9 months after the accounting year end is the following September.
And it has to be paid back from your personal account back into the company's account, is that
So
right?
the company lent it to you and you've got to pay it back, yeah.
How long before you can take it back out again?
Well, there's these teaming and lading rules, but basically if I was you, I would take the money out on the 1st of January the following year, and then you haven't triggered the first year, and then you've got 12 months plus 9 months. You've got 21 months.
Oh, I see. But then within the 9 months, you don't pay interest.
Yeah, you do.
Yeah.
Oh, you do benefit in kind. So what you're talking about, Section 455 tax, the interest will always run. If you borrow money from your company, there'll always be an interest charge.
What rate are you supposed to charge?
It's low, it's 2 or 3%.
Yeah, 3%.
If you don't do that, you'll get a PLMD benefit in kind charge because you haven't paid the interest on the loan.
And would you offset that loan against previous expenses that you've paid, but
Well,
you
then it
haven't
wouldn't be a
claimed
loan.
through?
No.
So if you've paid expenses for the company, you've got a credit in your director's loan account, say it's £6,000.
Right.
If you borrow 26, then really you've only borrowed 20.
20. All right. That's what I meant. Yeah.
Paris actually did that to buy property. And so what I did is that I needed the money to fund the property, borrow it from my business practice, and then operate a bit more, made more money, got more money, rental income, all that, and then paid back the fees properly within 3 months. So I'll Snapchat you.
Okay, ladies and gentlemen, can we hear it for our panel, please? We've got Mark, we've got Shaz, we've got Chris. Fantastic. So we're now going to take a lunch break. Gents, are you hanging around?